Hey everyone, let's talk about investments and specifically let's talk about asset pricing. And we'll begin our discussion of asset pricing by looking at single index models and what those actually mean. So this is going to be Bodie, Kane, and Marcus chapter 8. And first we'll talk about what some advantages of considering a single index model are, how we can use a single index model to decompose total firm risk into systematic and idiosyncratic or firm-specific risk, how we can actually estimate a single index model, and how we can actually tie it back to our prior discussion of portfolio theory to create an optimal risky portfolio in a different and potentially simpler way using this index modeling framework. So first, let's think about why we actually even want to know about index models and what advantages they have relative to our already described theory of how we might construct an optimal portfolio of risky and riskless assets back in our portfolio theory discussion from last time. And this sort of ties to a more fundamental concern that we have in investments, which is the idea of the study of asset prices as well as asset portfolios. In other words, asset pricing at its most fundamental is really just the study of individual assets' risk and expected return. And of course, from what we know about risk aversion and utility functions, we know that higher portfolio risk or asset-specific risk should mean higher expected returns, because for an individual who's risk averse to be okay with holding this asset, the more risky it is, the more they have to essentially be incentivized into taking it, following this idea of a risk premium, leading to a higher expected return. And what asset pricing then concerns itself with, and what we'll discuss here, is first of all, what kinds of risk get priced? Is it sort of the systematic risk that drives all risky assets to varying degrees based on their exposure to it? Idiosyncratic risk, the stuff that is sort of peculiar to each individual asset? Or total risk as the sum of these two? And furthermore, sort of what actually determines what price risk factors are. So, first of all, what is a priced risk? Well, it's one that actually fulfills this risk-return relation. The more exposed to it you are, the higher expected returns you should earn. That is a type of risk factor that is priced. A factor to which you can be exposed as much as you like, but you won't earn any more in expected returns, would be a risk factor that is not priced. And the key intuition to really a lot of asset pricing, even some of the more complicated academic models, as well as the sort of simple model that we'll talk about here, is that an asset that pays you more in what we call bad times, in other words, when you really value getting paid, is going to have a higher price, and if I move my head, you can see that it'll sell at, therefore, a higher price, and it'll have a lower expected return. And of course, those two are intimately connected in that if the price of a risk asset is higher, then there's less room for it to grow, and for any price change that does occur, the return, of course, is going to be lower relative to the same risk asset that had traded at a lower initial price. So the higher the price of an asset, the lower its expected return, all else equal. And a good example of this intuition would be that study that we did of the portfolio of a house and the homeowner's insurance contract. The insurance contract is maybe the most extreme example of an asset that pays you just when you really value being paid. In other words, when your other portfolio asset, the house, gets demolished in that really rare disaster state, that's when the insurance contract pays you. But that, of course, means that its price in terms of the insurance premium is fairly high. And in fact, if we go back to that set of lectures, we'll recall that the expected return to the insurance contract is very low. And of course, the expected return to most insurance contracts is actually negative. But precisely because of this idea of risk and return and risk aversion, people are actually okay with paying a negative price for certain assets, especially ones that pay you when other assets fall in price. In other words, assets that are negatively correlated, just as the homeowner's insurance contract was negatively correlated with the house. So that's sort of what asset pricing is. But now, why should we care? In other words, why is it not sufficient for us to simply stop at portfolio theory, where we did learn how to construct an optimal portfolio that really does make an optimal trade-off between risk and return? Well, for several reasons. So first of all, even if sort of portfolios are where we will sort of do most of our investing as either institutional or even retail investors, portfolios, of course, are made up of individual assets. And really, we want to know how financial markets actually price each individual asset. And portfolio theory doesn't tell us very much about that. And furthermore, related to this, we want to know how each individual risk asset actually performs. In other words, did we beat expectations? Did we fail to meet whatever our expectations were in terms of how much risk we took on, how much return we actually received? We may be able to do this with portfolios, but we certainly can't do this for individual assets with just portfolio theory. So we need asset pricing to sort of fill in these gaps, which sort of gets to point number 3 here, that really we want to know expected returns for individual assets, not just for portfolios. Both sort of to know what to pick to put into our portfolios, but also to diagnose what assets have been performing as expected, what assets have been underperforming. And as we'll find out in this discussion, we can actually use this sort of index-based asset pricing model to also construct optimal portfolios in a way that may be simpler than the Markowitz portfolio theory approach. So why might a approach to asset pricing with a single factor model or an approach to portfolio construction with single factor model be superior to portfolio theory? Well, the main issue is the simplicity, and here's what I mean by that. Essentially, you just have far fewer inputs to estimate for a single factor model versus the Markowitz portfolio theory model that we described last time. And that, of course, makes it easier for individuals who do investment analysis actually to specialize and perform their functions. So here's why portfolio theory might actually be challenging to implement. Let's think of an investment analyst who can track 50 stocks. Now remember, this actually means following the details of the quarterly earnings of each stock, all other corporate news, and indeed if we sort of look at how many stocks analysts usually follow, it's often closer to 20 stocks. So an analyst who can actually properly track and follow in detail 50 different companies is a superior analyst. But let's say we are such an analyst. And we now want to construct a portfolio of the firms that we follow for our clients. We want to build them an optimal portfolio of the firms that we know about. Well, that means that we need to calculate for the Markowitz model. Remember, we need 50 expected returns, and we need 50 variances, and we also need that variance-covariance matrix, so we have to have covariances. Now, how many covariances do we need if we have 50 risk assets? Well, as you remember from our example from portfolio theory, when we had a variance-covariance matrix of 5 risky assets, that matrix had 5 square, or 25 entries in it. So if we have 50, well, should we have 50 square or 2,500 entries in it? Not exactly, because remember, covariance of asset 1 with asset 2 is the same as the covariance of asset 2 with asset 1. In other words, the matrix is symmetric about the diagonal. So really, it's close to half of the number of assets squared, and the precise formula is the number of assets squared minus the number of assets divided by 2. Essentially, we're taking the full matrix, we're taking out that diagonal row variances because we have those already, and then we're dividing by 2 because the matrix is symmetric about the diagonal. So if we have 50 assets, that means that we need 1,225 covariances. And remember, for portfolio theory to really work well, all of these, I guess, 1,300 parameters have to be forward-looking estimates, right? It's not sufficient to just estimate historical variances, covariances, and returns. We really want to at least try to get a sense of what these might be like in the future. That means that we need 1,325 parameters to estimate, to run portfolio theory according to Markowitz. And this is going to be a challenge, right? First of all, we need enough data to do this reliably, so it's a difficult data science problem. And even if we have enough data to do this, there's just a lot of estimation that we need to do. And if every point is a forward-looking estimate, with error, of course, that means that that error is going to add up. And importantly, this is actually a relatively small-scale problem. Because if you think about, let's say, a mutual fund now that is going to track the S&P 500, and they will try to create an optimal portfolio of the S&P 500 constituents. Well, with 500 risk assets, you need 500 expected returns, 500 variances, and following that formula for the number of covariances in the variance-covariance matrix, 500 square minus 500 over 2, we need about 125,000, just shy of that, covariances. And that's not as bad as it can get, right? What if we consider a even larger risk asset universe, the Russell 3000? Well, then we have 3,000 expected returns, 3,000 variances, and about 4.5 million covariances. So by that point, either you have to go real far back to just get enough data to address all of these estimates, or you won't be able to do this at all. But even if you go very far back, then you face the risk of essentially using data that is out of date. Firms change. So whatever information that you actually have estimated using historical data to create your forward-looking model might actually be obsolete by the time you amass enough of a track record for each of these 3,000 stocks to actually try to estimate these 4.5 million parameters. But even that's not as bad as it really gets, because even if you are able to estimate so many parameters, in other words, you're able to at least get some sort of number. The problem is each of these numbers is going to be estimated with noise. And when you have 4.5 million parameters each estimated with noise, and you're going to use that as the input into your optimizer, the way that we did in that 5 risk asset example, well, the noise and estimates is just going to swamp any signal that your model actually was hopefully generating about expected returns and expected risks. So really, portfolio theory applied to large universes of risk assets becomes a bit unwieldy. It's sort of really vulnerable to noise and estimation. Just minor changes, let's say to the time series of one individual asset, can potentially mess up your covariances for all of the other assets with it. And then when you apply an optimization to those parameters estimated with noise, you will then get vastly different solutions. So in other words, it's very fragile to minor perturbations in the data. And that suggests that it might not actually be getting you a very reliable signal after all, once you actually expand it to a large enough population. So this sort of suggests that portfolio theory with sort of a fully specified variance covariance matrix is challenging to implement. So how can we solve this problem by looking at a single factor model? Well, first of all, let's actually define what we mean by a single factor model or a single index model. And here is what we mean. We're saying that the return to any risk asset is going to be, of course, centered about some sort of expected return, and any noise in that return is going to be driven by two components. A single macro factor, which sort of drives this term of a single index model or a single factor model. But the single macro factor isn't going to be enough to explain everything. There's also going to be a firm-specific error component. So here, beta is sort of going to be our individual risk asset sensitivity to the common risk factor M that drives the returns of all risk assets, just depending on how they are exposed to it more or less. And that risk factor will actually be sort of what drives systematic risk. And then the rest is going to be this firm-specific noise. So technically, any common macro factor can be used to create a single index model. Anything that is not explained by it will be, by definition, a firm-specific surprise. But of course, then a common or a very intuitive way to pick our single index or single factor would just be to look at the market of all portfolios. Just because most risk assets, especially, let's say, most stocks, move together. And when the portfolio or the total sum of all risk assets or all stocks is up, all stocks are going to be up just by varying degrees. And when the total portfolio of stocks is down, well, all stocks are usually going to be down, again, to varying degrees. And generally, we observe that a riskier stock is going to move up more when everything else moves up, and is going to fall more when everything else falls. And a less risky one will move up less when everything moves up, and will move down less when everything moves down, just because essentially it's less sensitive to the macro environment that is actually causing these fluctuations. So how do we actually look at this single index model in terms of asset returns, because we don't really know what the expected return is ex ante? Well, another way to formulate it would be to say, all right, we're going to take the excess returns to any individual risky asset. In other words, we'll take its total return, subtract the risk-free rate, And then we can essentially express the single index model as a regression equation. That isn't to say that the single factor model is a regression equation, but it's that a regression equation can be used to estimate it. So we're going to say the excess return to any individual asset is going to be some alpha, positive or negative, plus the beta, in other words, the risk asset's exposure to the macro factor, times the excess return to the macro factor, plus whatever firm-specific noise there is. And if we take expectations of both sides, then we can actually get this simpler relation for the expected return, or well, expected excess return, to any risky asset. So the reason that the firm-specific error term drops out is because an expectation that's going to be 0, right? For any arbitrary, let's say, stock, well, there's not necessarily going to be any firm-specific noise coming out in any particular time, and if it is, it may be good, like a new patent, or it may be bad, like a corporate scandal, or the CEO leaving for another firm. In other words, we don't have really a sense of what the firm-specific noise might be at any point in time, so we will assume that an expectation, the firm-specific noise, is going to be 0. Sometimes it'll be good, sometimes it'll be bad. For riskier firms, it might have a high variance, but for all firms, we assume it has 0 mean, just because if it were otherwise, it would actually get absorbed into the interceptor.